Hello everyone and welcome to today's session organized by Tilburg Institute for Private Debt, an open platform to promote research, education and networking in the field of private debt. My name is Pacal Böni and I am the Managing Director of Tilburg Institute for Private Debt at Tilburg University. Before I introduce our guest and interview partner, let me give you some useful information regarding our webinar. It will have a duration of 1 hour, including an interview part of approximately 40 minutes, followed by a Q&A session directly with our interview partner today for approximately 20 minutes. We'd love to hear your feedback, questions, and opinions. So if you have questions that you want to ask, please use the Zoom chat function. Questions will be moderated by my colleagues of Tilburg School of Economics and Management, Professors Philipp Joos and Marco Doreen. A recorded version of this webinar will be made available to you after our webinar. You may review this webinar on our website, and we will send you a link once it is uploaded. Having said this, let me welcome and introduce today's interview partner, Jürgen Rigterink from EBRD. Today's guest is an expert in non-traditional debt. We met at IMD many years ago in an executive course on high-performance boards. Ever since then, I follow his impressive activity. Jürgen is EBRD's first vice president and the head of its client services group, which is comprised of the banking and policy and partnership departments. He heads the investment committee of EBRD, overseeing annual investments of approximately 10 billion euro invested into small and medium-sized enterprises and spread over some 400 to 500 projects. The aim of these investments, according to their homepage, is to support environmental sustainability, facilitate trade, and develop capital markets. With currently some 40 billion euro of outstanding commitments, EBRD is one of the largest providers of non-traditional bank debt. Jürgen has overall responsibility for the implementation of the banking and policy objectives of EBRD, ensuring that EBRD invests in policy engagement and advisory services that deliver the maximum transition impact wished by EBRD. Jürgen Rigterink was also EBRD's acting president, running the bank in a transitional period between the departure of the old and the arrival of the new president, Odile Renaud-Bassot, from July to November 2020. Prior to EBRD, Jürgen was the chief executive officer and chairman of the management board of FMO, the entrepreneurial Dutch development bank. Before his time at FMO, he worked in the private sector at ABN AMRO, where he ran the company's activities in Kazakhstan and held a number of senior positions, including sector head of Central and Eastern Europe, Middle East, and Africa. So let us start to profit from Jürgen's kind willingness to share his experience with us today. Jürgen, we welcome you to this webinar, and maybe it's best that you introduce yourself and EBRD to our participants. The floor is yours.
Thank you very much, Pacal, for your kind introduction. You actually left out that although my origins lie in Germany, my alma mater was the University of Groningen. At the time I studied there business economics, the university, I would say, was clearly ahead of the University of Tilburg. But I have to admit, chapeau for what you and your colleagues have done in the past year. It's really, really impressive to see how the University of Tilburg thrived during the past 20 or 30 years or so. But to answer your question, Pacal, the EBRD was set up in haste to meet, let's call it the challenge of an extraordinary moment in Europe's history, namely the collapse of communism in its east. In fact, a mere 18 months elapsed between the first mooting of the idea of a European Development Bank by President François Mitterrand of France. And this was, I believe, somewhere in October 1989, and its opening for business with headquarters in London in April 1991. And since then, we have played a historic role in fostering change in the region and beyond, I might add, by investing over 150 billion euros in more than 6,000 projects. Uniquely for a development bank, the EBRD actually has a political mandate, which goes hand in hand with our policy work. Or perhaps to put it differently, our financial investments are intertwined with policy engagements. This is because we believe that change can only come if we can influence and address the systemic problems affecting many countries in which we operate. And examples of this are banking systems reform, privatizations of SOEs or state-owned enterprises, or for example, the creation of proper legal frameworks for property rights, all vital ingredients for change, of course. We are currently active in nearly 40 countries, from Central Europe to Central Asia and the Southern and Eastern Mediterranean, plus the West Bank and Gaza. And that is because since our start in 1991, EBRD has expanded its original region of operations 4 times already into new countries such as Mongolia, and this was in 2006, Turkey, 2009, which is, by the way, currently our largest country of operation. Almost 15% of our portfolio of our total operating assets are currently in Turkey. Then came Egypt, Jordan, Morocco, Tunisia, and Kosovo in 2012, and more recently Cyprus, Greece, and Lebanon. And we are currently discussing with our shareholders if we should not expand one more time, this time to a select number of countries in sub-Saharan Africa. Interestingly enough, the Czech Republic is the only member to have graduated from the EBRD, which it did in 2007, so just before the financial crisis. However, this year, after request by its government to help with the recovery of the pandemic, the bank agreed to resume investing in the country for a limited period. By the way, we have offices and local presence in all of the countries we operate, as we believe this is key to our business model. And then perhaps lastly, what kind of investment products do we offer to our clients? It's actually a fairly broad range: trade finance, senior loans, mezzanine, PE and VC investments, so private equity or venture capital investment, equity and debt funds, project finance, etc. And then perhaps still one last thing, we currently have 71 shareholders, 69 countries, including all our countries of operation, as well as the EU and the Nordic Investment Bank.
As we are the Institute for Private Debt, I would like to ask you, how do you define private debt at EBRD? Have you noted about the increasing importance of private debt, as we would say is the case? And then according to your definition, what portion of your business would you define to be private debt, and what portion would be, traditional bank debt? Over to Jürgen.
What is our definition? It's obviously a good question, but not unexpected, of course. I guess I would use the more, let's call it traditional definition, that private credit is non-bank lending to companies and businesses. But you are a professor and presumably be quite smart, so you will likely challenge me on this by saying, but wait a minute, Jürgen, the B in EBRD stands for bank. Yes, indeed, Pascal, that is true. But as EBRD is not your typical bank, I believe that lending by IFIs and DFIs, DFI, by the way, stands for Development Finance Institutions, should not be or should be included in this definition. And if we follow that logic, then most of what we do is private debt indeed. And that is probably the reason why I'm here, as about 75% of our annual investments are in the private sector and over 90% is in debt.
Thank you, Jürgen. As we are very polite, we will not challenge you. And by the way, there is nothing to challenge. I think your definition is completely correct. So non-traditional bank financing, maybe not traditional public market financing or debt capital market transactions would be defined as private debt, very much comparable to private equity. So knowing that you are executing like 75% of all your investments in a form delivered that you would define not to be traditional bank debt, can you talk a little bit about those sorts of projects and why you believe, I think you will believe that, otherwise you wouldn't do it, you believe that private debt is really supporting the financing activities and why this is needed? Do we need private debt at all in the market?
That is an excellent question and perhaps a logical question for our listeners in developed countries. And that probably means 99% of the audience, and I can only see a very small part of that on my screen. However, access to finance is actually a key challenge in many markets where we work. And many developing markets remain largely bank-dominated with underdeveloped capital markets, and the level of financial intermediation is much lower compared to developed markets where you are Swiss, or in Belgium, or in the Netherlands, or elsewhere. So we therefore see that, for example, SMEs remain, let's call it underserved, and long-term funding is often scarce. And this is also due to a large number of challenges in these markets. And just to name a few, firstly, there is the different risk perception by investors for our countries of operation. There is, let's call it a gap between the perceived risk and the actual risk. But we all know, of course, that perception is reality. Secondly, I would say that larger international commercial banks, and we all know who they are being forced through increasingly stringent regulation to stay close to their home markets and close to their core clients. Thirdly, there's probably the local currency aspect. International banks do often not have local currency funding bases and are often unable to fund local currency loans at competitive rates. Fourth point, and this is particularly probably true for asset managers and institutional investors, investing in non-rated or non-investment grade assets, which are of course common for the EBRD region and for other emerging markets, makes them penalized by high capital charges and therefore obviously not very financially attractive. And probably lastly, and that is more related at these kind of times, and hence we also have this kind of setup, markets are adversely affected by COVID. And for example, we saw a over 20% decline in the syndicated loan volume in 2020 in our markets. And for us, that was the largest volume decline since the financial crisis in 2009. Lenders were tightening risk appetite, and that is actually nicely put, because some banks closed the doors completely in emerging markets, and there were actually months of inactivity in the banking market due to the uncertainty caused by the pandemic. And this is actually where we step in, or maybe some people might say where we step up. We actually can show that with a track record of now over 30 years, one can achieve a positive financial return in the region. And this is not just theory, as I can tell you that our write-offs are consistently below 1% per annum, even though our NPLs are not that low for that matter. And if you want, or if one of your listeners wants, I can explain later why the relationship between NPLs and write-offs is a different one at EBRD and at many other IFRs and DFRs compared to traditional banks.
Before I ask the next question, I would like to remind our guests today to ask questions in the chat, because my colleagues are collecting questions. They're desperately waiting. So if you have questions already, just put them in the chat so that we can discuss them in the end of the webinar. Back to Jürgen. So you said you kind of can finance projects that would not fit into the standard banking scheme, if you like. So, and you would also less penalize maybe certain risk factors or risk categories, such as like today, the COVID-19. So I imagine you must be a very interesting financing partner, not only to corporates, but also to maybe banks that want to offload some of their risks. Let's say they take the good risk and you take the bad risk. I'm saying this consciously a little bit aggressive, so you can differentiate maybe between the 2 or 3 categories of risk. So how does that work? How do you receive project and funding requests? Is this primarily presented by banks as intermediaries to EBRD? Is this done by trustees, by other intermediaries, by financial advisors? So how do these projects, appear on your table? And how do you look at them? What are the main criteria you would be looking at to co-finance, let's say, a project or a corporate? Back to you.
Yeah, in terms of how we originate our projects, I already mentioned we have boots on the ground. We have very strong local offices. So it's actually all of our projects, or most of our projects, they're being originated by ourselves. And by the way, the fact that EBRD is truly an established name in many of our markets. Actually, many of our clients, after working in the region or in a country, they actually knock on our door. And so we don't usually have, let's call it brokers or other banks bringing us projects. But of course, that happens as well. In terms of how we assess a proposal or so, I would say in terms of risk management, the differences are actually not that great. And you mentioned that I indeed also worked for the private sector, for the ABN AMROs of this world. And just right now, we also had a pre-chat with one of your colleagues in Belgium. I also worked for Banque Bruxelles Lambert in Belgium and the US. And I think for most of these banks, I have heard the term sound banking, i.e. projects need to be financially viable. And this is the same for EBRD as well. Of course, you can say our risk appetite might be slightly greater. Sound banking is the main principle of everything we do. But of course, EBRD projects also need to meet other criteria. And I'm not going to go through all of them, but for example, what is kind of specific to us is the project needs to have what we call a transition impact. This means that it needs to promote, how do I put it, transition to market economies, private ownership, good governance with respect to people and environment, for example. What also is very important for us is the project needs to meet our what we call additionality criteria. We do not want to compete with traditional banks or institutions. We do not want to replace private investment, nor do we want to distort the market. Having said that, additionality does not always mean financial additionality. It can also be that we are together with other banks in the same project, where we actually bring our green credentials or so to the table. Another distinctive feature of EBRD is our high, I probably should say very, very high integrity standards and compliance and KYC requirements. For the people who are not working for the bank, KYC, know your client requirements. And this means that working with EBRD for many clients also means that they have received or receive an important kind of, let's call it a stamp of approval. When you look at our loan agreements, Pascal, they follow by and large market practice for cross-border lending. And for the bankers here or for the specialists, we use often the Loan Market Association or LMA template. And we are also following commercial practice under mostly English law, or at least as closely as possible. The main difference in this respect lies in our policy requirements, including our environmental and social aspects, and probably I also should add our prohibited practice. And the projects we finance need to comply with our very strict environmental and social standards. By the way, on the screen, I just also noticed a previous environmental and social government standards practitioner specialist from my former FMO life. Welcome, Walter. So I'm sure he will challenge me on a few things there. But these standards are also covenanted. Furthermore, due to our mandate, the use of proceeds is usually clearly defined, and by the way, also covenanted. Examples of this include achieving increased energy efficiency. So we just not give just money, but we say, no, you need to use this for to increase your energy efficiency. For example, the introduction of innovative technologies, the expansion of production capacity to tap new markets, targeting underserved segments, for example, SMEs or women-led businesses, etc., etc. And then probably this would have or might have been a question as to enforcement. Our attitude, like probably any other commercial lender out there, is that we have to be ready to enforce, I would say, any of the terms of our lending contract, including our security interest, if needed.
So you said there is this additionality criterion within EBRD. You're not going into competition with banks. You don't want to replace them. So logically from that, I would assume that you take the risk portion that is maybe the second lien portion. So to some extent, it might be that you take more risk. So can you talk about how you look at that, how you share those risks maybe with other partners? And then if it is true that you go into a risk that is slightly or even substantially higher than your competing or non-competing banks, but cooperating banks, what's the return then? So if the bank, let's say, receives a 2% coupon, will you be at 4, 6, or 8, or will you be at the same level? And then if so, how do you look at return? What is exactly the return measurement or proxy that you're using at EBRD?
You know, after 1 year, I'm still not completely used to it, which is. But look, there were a few questions in this one question, and first is how we work actually together with let's call it other lenders. And you were basically saying, oh, you must take more risk than others. Actually, we usually don't. We share risk, and in our kind of world, it is called mobilizing, and mobilizing really means trying to get the private sector in there as much as possible. Perhaps, and I might have, I probably should have stated that a little bit earlier. There is actually also, there are many reasons to work with EBRD if you are a commercial lender. And I should probably start by reiterating again that EBRD enjoys what is commonly known as a preferred creditor status. And this is actually documented also in our agreement establishing the EBRD, which among other things exempts EBRD borrowers from currency conversion moratoria. And before you ask the question, Pascal, has this ever been tested? And the answer is actually yes. This was first successfully tested during the Russia crisis in 1998. Anyhow, going back to your question, it is actually one of our goals to maximize private co-financing. What is better to achieve impact with other people's money or other people's capital? So every year we mobilize directly between 1.5 and 2 billion euros, and trigger, by the way, amounts closer to 10 billion of private co-investment. And we actually even have a dedicated distribution team of mobilization specialists who are in constant touch with the market. And they are working with, just to give you a little bit flavor of the scale, we are working with over 100 banks or insurance companies or institutional investors like pension funds and asset managers, and also other DFIs like indeed here in the Netherlands, where most of your listeners are in the Netherlands, FMO, indeed probably one of the best and most agile DFIs in the world, but also like impact investors, and we offer them a wide range of instruments to share our risk. And these instruments, if you allow me, I would actually mention 3 of them: B loans, URPs, and URP stands for unfunded risk participations, and parallel loans. And that also will explain a little bit your question on the margins, etc. First, AB loans. AB loans allow EBRD to mobilize commercial providers like banks or funds or insurance companies into a project under, let's call it EBRD's umbrella, through entering into a sub-participation with EBRD. So EBRD remains the lender of record of the entire AB loan and can share its preferred creditor status and other privileges with co-financing partners. So basically that means they are getting the same kind of economics as as we do. During the past 30 years or so, B loans have contributed to the majority of our mobilization amounts, ranging every year between 800 million and 1.5 billion or so per annum. However, over the past 5 years, our B loan amounts actually declined. And that is due to a combination of external reasons. I already mentioned the regulatory changes that make B loans less attractive to banks, but also due to a change of our own project focus. EBRD started, for example, to do more local currency loans or longer tenor transactions, and that makes it much more difficult for banks to match. So therefore, by the way, I expect this trend this declining trend to continue. The demand for local currency mobilization is actually addressed by what I said is kind of the second instrument, and that is EBRD's unfunded mobilization program. As URPs, again, I will repeat it again, unfunded risk participation can cover both hard currency and local currency transactions for often substantial tenors in a wide range of countries. And what started there with, let's say, 80 million in 2016, when we introduced URPs, now basically contributes over €500 million per year. And there, since we are with a very small group, and this is all a Chatham House rule, probably not, but there it is indeed the case that, let's call it, we skim some of the margin, because for these investors in our URP, they take a different kind of risk, because we take more risk. And there you do see indeed that in most of the cases, we don't give the full margin which we earn on it. We don't pass that on. Lastly, parallel loans. Parallel loans, they remain a very important instrument. And we saw also a partial shift, as I mentioned, from B loans to parallel loans, as commercial banks prefer using their local bank subsidiaries for booking loans rather than providing cross-border debts or so. By the way, these instruments are not mutually exclusive, as we sometimes use all of them in one project. And a good recent example would be in my kind of like second or third home country, Kazakhstan. And there we did only last year, we financed a ring road. It was called Bakat. And it's a ring road around Almaty. Let's call it the economic capital of Kazakhstan. That's the city I lived for 3 years, heading ABN AMRO. And Bakat was the first public-private partnership, or PPP, in Central Asia. And there we achieved almost 300 million in mobilization by utilizing a combination of B loans, unfunded risk participation, and parallel loan mobilization instruments. And this in spite of a very complex transaction structure, a very long loan tenor. And by the way, last year, remember, deteriorating market condition driven by the pandemic.
So I'm still coming back on this risk and return kind of dimension. You said you're additional. At the same time, you were somehow acting like a lead arranger in a syndicated loan group, if I look at these B loans that you just talked about. So I was wondering, when you were talking about your instruments, there is an interesting paper just now out in the Journal of Financial Economics on impact investing. And what the paper finds basically is that there is a category of investors who sacrifice returns in exchange for some, ESG, green, whatever kind of impact return. So would you say there is a non-pecuniary value or non-pecuniary utility that you would also count into this total return calculation? And how do you look at risk? It will be exchanged prior to the seminar. So you said we do something like RAROC. So what is the non-pecuniary impact investing component of your return, if any?
Yeah, thank you. I'm afraid now I probably have to be a little bit more technical, let's call it that way. Maybe first, our risk-adjusted financial performance of EBRD in its entirety is basically assessed within the bank's corporate scorecard. So this is what we agree with our shareholders via two ex-post metrics. First is return on required capital, or maybe in your language, work. This is the total growth in equity divided by the average required capital, and this is calculated on a 3-year rolling basis to obviously dampen financial volatility and also provide an overall view on our institutional performance. And the second one, probably more relevant for this discussion, is the debt RORC. That's debt operating income after impairment divided by the average required capital for debt. In this case, or in the case of work, the target minimum level is set based on analysis of the bank's long-run return on deployed risk capital. But you actually you also mentioned RAROC, so maybe I should say a little bit on that. And again, apologies if it's too technical, but for debt projects, we indeed utilize so-called risk-adjusted return on capital methodology, risk-adjusted return on capital, or RAROC. This is used by many banks, not only IFIs or DFIs, also in my previous bank, ABN AMRO, or the Citibanks of this world. It is one of the instruments. And it is basically an estimate of the return on capital for projects at the point of approval. And the tool is also used for portfolio monitoring to provide, let's call it an up-to-date outlook on risk-adjusted returns based on contractual margins and current risk ratings. As with every model, RAROC provides, let's call it, only a simplified view of transaction-specific risk-return dynamics. And while it is an important input into project approval consideration, we don't use automatic rules or hurdle rates which would exclude projects just based on RAROC alone, especially as financial returns have to be considered in conjunction with policy and strategic objectives of the bank. So maybe a few more words on that one, if you allow me. So the bank assigns a so-called probability of default, or PD, to each counterparty, as well as a loss given default to each facility and product. And for debt products, PDs are generally computed using third-party scorecards. Well, it probably gets a little bit too technical, but basically a RAROC model, it doesn't mean that lower margins are automatically a bad thing. Only yesterday, actually, we had a meeting with our finance colleagues, and we analyzed the average margins of the bank of last year. And guess what? Despite the pandemic, our average margins actually went down. But is that, I mean, automatically you probably would say, oh, that's a bad thing. No, pandemic, risk arguably going up, your average margin went down. Well, actually, it's not. If you know that the reduction in the average margin actually came together also because of our tenors materially went down. So the tenors of our loan, that there was a higher percentage of investment was done in the FI sector, in financial institution sector, which have historically a lower margin because of lower risk. And the fact, for example, that we did more in certain regions where margins are in lower. For example, I'm sure you can understand that in general, the margins for a transaction in Poland are lower than in Tajikistan. And then to your comment on impact investing, at FMO, we also had a long discussion on that one because we also tried to set up, actually FMO set up funds which basically were labeled impact, were targeted for impact investors. What is impact investing? I think you can have a whole hour just based on that. You have the, and sorry for being a little bit blunt and black and white. What I now say is, of course, not completely true, but you have more the American definition. You know, as long as you don't invest in cluster bombs, it is an impact. Or you have, let's say, the more German definition. It is all about doing good, and it really doesn't matter what the returns are. It is more about capital preservation. So there's a whole range between these two. And actually what we are saying as EBRD is we don't want to make that choice you just mentioned, Pascal, because we believe, and it's not only we believe, we show, I just explained to you that every loan or every transaction we do has to have a certain impact. So we believe that everything we actually do should be part of this impact investing universe. And we don't want to say, oh, this is a high impact transaction, so therefore we can live with a lower return. Because if we would do this, then maybe we would attract a few impact investors, but we wouldn't attract all the other institutional investors, banks, etc., which I just outlined.
Very interesting. So I understand that you were talking that these projects or loans or potential loans are assessed on a probability of default basis, and then on a loss given default assumption. Looking at your numbers and exchanging with you, I have the impression, I'm of the impression that EBRD has lower loss given defaults. Is that correct? So if I listen to you, you're very close to clients, you have this impact aspect, you kind of cooperate on a very professional basis with local partners. So is it true that the loss given default, so once a company has a default, is then lower than what we would see in the capital markets, like debt capital markets, public markets, with bonds, or for example, with loans at banking institutions? What is the loss given default, if you can elaborate on that a little bit, and how do you compare it to your, to the debt capital markets in general?
Just writing down the question, otherwise I'm getting old. So look, the LGDs I just mentioned was, of course, we do this ahead of every project, but it is indeed true. And now I'm coming back to an earlier comment I made, that our actual losses, our write-offs, this is what banks are using, they're actually much lower than what you would expect. Our portfolio has a non-investment grade. It's a non-investment grade criteria, but it somehow behaves like investment grade in terms of returns. And our write-offs, by the way, are also, as I mentioned, quite low. And it's not only us, by the way, other IFRs and DFRs have that as well. So I already mentioned some of the reasons why, and we have a special status compared to some commercial international institution. I already mentioned the preferred creditor status and others, but there's something else. If I now tell you that our NPLs are above 6%, and by the way, I tell you that because it is true, our NPLs at this point in time are over 6%. But I'm not concerned that our write-offs actually will go up, because what we actually do much better, I would say, than the private sector is we have, and let's combine this now with the COVID situation, we have an extremely good hospital. We have specialists, corporate recovery specialists, and we are willing to put the extra effort into clients who we see struggling, and extra effort means either in terms of advice. As I mentioned, we also have a policy engagement. We have advisory for small business. So we're not only giving money, we actually also provide advice. But also, if needed, we give them more money. Of course, we don't throw good money after bad, but we're willing to make that investment. And in certain cases, this means that we actually that these clients are in our hospital for many, many, many years. And this is something which doesn't necessarily happen in the outside world. At commercial banks, because there you very often see, oh, let's not go through the trouble, let's just sell it at the loss, etc. So there banks do much earlier take losses. So it's actually a combination of several factors which explains what you indeed noticed.
You also mentioned that you kind of use LMA templates or standard loan agreements, and I was wondering if you look at the ESG or green or impact investing, would it not be possible, or you even wished for, to design those contracts also to some ESG criteria? So if you say default, are you really talking about standard loan defaults, or do you also have default criteria that would in effect be ESG or impact investing covenants or covenant breaches when they default?
I'm here to market in a way EBRD, but now it becomes a slippery slope. And these are questions, by the way, which we haven't rehearsed or so. So this comes, of course, a little bit. I didn't expect it, but there it is actually a weakness when I say they have been covenanted. We actually have hundreds, and actually I don't want to use the exact, I don't want to give you the exact number, but we have quite some covenant breaches. And here you see that it's quite different, that for a minor breach in, for example, an ESG covenant, do you really put the entire company into default with possible cross defaults, etc. So it's a very, very difficult one. And there I have to say, and it's just because he is one of the few people who have the camera on. So I have to look at Walter again. And this reminds me of the FMO days. And at FMO, we had exactly the same issue. And what works better, the carrot or the stick? And we actually felt that this stick of being able to call a loan doesn't always necessarily work very well. And this is something we also use more and more at EBRD. We give them an incentive actually to do something. So we have, for example, an ESG, an action plan on one of these pillars. And we actually say, you know, if you do this and this and this, if you decarbonize it, and we obviously afterward we'll check it, actually what will happen, we give you a lower margin. We give you a discount on a margin. So there's actually an economical reason for a company actually to do this. And even from a banking point of view, you can actually say, well, it's actually good banking practice, because if a company is actually doing this, it also lowers your risk on ESG, etc. So in a way, your risk reward doesn't become worse. In a way, you can even argue it becomes better. So, so on the governance side, it is, and I see Walter with his thumbs up. Always good that the former colleagues still agrees with me.
It's interesting to hear you do have some, let's say, in a broader sense, ESG kind of measurement and assessment of your lending projects. Let me switch over to a more research-focused maybe topic. We at TIPD Tilburg, we believe that really the private market investing in terms of lending is heavily under-researched. But maybe we misunderstand the market, which I don't believe and don't hope. But can you talk about how you get information about like private debt contracts, you know, private debt funds, what they do, how they operate? Would you agree with the statement that private debt in general is under-researched? So everything outside of the typical bank and syndicated loans and debt capital market research topics?
Oh, this is a difficult one, because I better say yes, it's under research now. Otherwise, you will be soon out of a job. Look for us in terms of research. As I already alluded to, our boots on the ground, our local knowledge, these are key to our business model and are probably the most critical part of our research. On top of that, our banking knowledge is actually supplemented by a team of country and sector economists and political advisors. For example, we have an office of the chief economist that undertakes economic research and provides. Let's use the word intellectual leadership on the economic aspects of transition and economic transformation in these countries of operation. And they also support the bank by monitoring macroeconomic developments and risk, etc. In fact, our head of research, Ralph de Haas, has an affiliated part-time position apparently with the Tilburg University. I didn't know that, by the way, before you reached out. Having said that, and now I come to your question, we do believe indeed that more research is needed in many areas. I think we have a pretty good knowledge on how PE funds, how private equity funds create value. But how is value actually created in private debt? With equity, funds often get control or advisory board seats and can work much more closely with management. With private debt, that of course it gives more flexibility than regular creditors get, but the scope for value creation may be limited. And that is, for example, one of the many areas that is not very well understood for the time being. So yes, there are a few other areas as well. So I agree with you, Pascal.
Have the first questions now coming in. I would like to kind of open the dialogue to our webinar participants. There is one question I would like to ask you, Jürgen, and the participant asks, you're cooperating with other lenders, and all these lenders, including EBRD, are more and more subject to United Nations ESG rules. So there are more and more rules. Would you expect the role of EBRD within the ESG investing industry become more important in the future, as you're already involved in this sector? And then if so, would you make a distinction? Is there any concept or opinion, let's say opinion, which is a very dangerous question. Could you differentiate between a good ESG investor and the greenwashing ESG investor? I mean, let's call it a personal opinion, so not to bring you into a delicate corner. So do you have an opinion personally, maybe not EBRD's opinion necessarily, whether there is greenwashing in the market, or banks just saying they do ESG, but in fact they're just hunting returns, or how do you look at that?
Yeah, that's a very, very good question. By the way, ESG, I'm happy that eventually you went to green. Because ESG, environmental, social, governance, I mean, we all use ESG, but it's not one topic. No, I mean, it's very diverse. So let's focus a little bit on green. Green is also an important part of our mandate, of EBRD's mandate. But also there, it's fair to say that our approach to green finance has evolved. Now, in the early 90s, we had a climate change team already in '94, by the way. We set our first climate targets in our corporate scorecard since 2006. But also there, when you look at it, only, well, probably now in June or at our AGM a few weeks from now, we will officially decide that all our activities will be fully aligned with the goals of the Paris Agreement by December 2022. So you see that for every bank, even with a bank with some green DNA, things are shifting. In fact, only last year, we decided that we want to become a majority green bank, and that more than 50% of our annual investments in 2025 should have a green angle. But then we go into maybe part of the question, greenwashing. And let's be critical about EBRD. We define green investments as projects or project components resulting in measurable net environmental benefits relative to baseline scenarios. But that can mean, and it actually does mean, that when we finance a road project, that actually a road project can have 20 or 30% or sometimes even more is part of a green, because cars are, for example, the Pacal ring road I just mentioned. It's good for the environment because there are less queues, less traffic jam. Sometimes it goes hand in hand together with other mitigation things. But when you really think about it, maybe a road also invites people to buy another car, etc. So there is, even with a bank like ours, there's quite some there's quite a big gray area, and that is why I think more global initiatives are so important. For example, EBRD was the first MDB to become a supporter of TCFD. And the person who asked that, I'm sure, knows what it is: Task Force on Climate-Related Financial Disclosure. So I think more and more we have more and more standards where greenwashing becomes more and more difficult. But of course, I mean, I don't know who the question comes from, but of course there's greenwashing in our industry, but mostly outside.
So we have another question. So maybe we have room for two questions, I would say. And the question is, do you always hold your loans until maturity, or do you sometimes also sell loans in the secondary market?
In principle, we are a long-term investors. You also see us, when you see us coming in capital market transactions as a, let's call it an anchor investor. Why do clients like us? Because we do have a long-term view, and we don't sell on the market or so. So in principle, yes, we hold till maturity. It doesn't mean that we never see repayments of loans. And clients, they do evolve. Sometimes you have situations where a client, for whatever reason, has access now to capital markets. So you do see refinancings, capital markets to for example, senior debt, because it's also a diversification of financial instruments. But in principle, yes, we do hold to maturity. That is, by the way, on the debt side. When you look on the equity side, we also have equity investments. It's a combination of when do we think that the financial returns are there, when are we satisfied with that? Plus, and that's a big plus, when actually our mandate, when our transition impact objectives have been met. There it's that combination.
Thanks a lot. We have exactly reached the time limit of our webinar. So I want to give you a great thank you to EBRD and you personally, Jürgen. It was a great pleasure to have you in today's webinar. As I announced in the beginning, we have recorded the webinar. We will put it on our website, maybe change a couple of things so that it looks nicely. But you will be receiving a mail once the webinar is online on our website. And I think I have received a last remark here, which might be a nice closing of today's webinar. That's Walter. I think you mentioned Walter before. And Walter writes, the only thing I can challenge you on, Mr. Rigterink, is the fact that you chose Groningen over Tilburg. So I would say, whatever university background you have, I think it's great. We are very thankful that you shared your great experience with you. with us, and that you took the time to kind of come to this webinar. And we're very happy. We also get permission to put it on the website so that more than just the participants in the webinar can profit from your knowledge and experience. In that sense, to everybody, thank you for participating in this webinar. Special thanks again to Jürgen. I would love to see you all in our next webinar, which we will announce again on our homepage and website, which you might visit. If you just plug in Tilburg Institute for Private Debt into Google, you will see it and you will be announced any new webinars under the condition that you kind of make yourself visible and use our news button so you receive those invitations. Thanks to everybody. It's time to close the meeting. Thanks again, Jürgen, and see you all soon. Thank you. Goodbye.